Now, before we turn to Asia, we'd like to remind you, please like, share, subscribe. Your support is appreciated. We just wanted to talk about Iran for a second, and we'll talk about it more in the EIA show. But there have been two fires. So their largest naval vessel has caught fire and was sinking, or I'm not 100% sure if it's sunk totally. But again, a big issue because it is the largest Iranian naval vessel, which was supposed to be going to Russia. It was initially thought to be going to China. Now it was said to be going to Russia. And now their largest refiner in Tehran caught fire and was fighting a massive fire, which was caused by one of their liquid gas pipes, emergency liquid gas pipelines exploding. So we've talked about the Mossad and how intelligence is leaking out of Iran, and just remember there is an election coming up in the next 2 weeks, which is so now the U.S.-Iranian deal is being delayed or is breaking until June 10th. So you're starting to get some of that baked in, but Israel essentially said that if the U.S. isn't going to help stop the nuclear program, they're going to go at it alone. And then we're followed by two very big explosions. Now, are they coincidental? Maybe. Unlikely. Maybe the naval vessel is very old. Maybe that did happen. But the explosions that we're seeing within the Iranian country are happening more and more frequently. And this is something where, as we've said, there's a lot of dissenters within the Iranian populace. So it's much easier for Israel, the Mossad, and some of the other entities to find support and carry favor with some of the locals that would be more willing to carry out events that would impact Iran without killing, civilians. Because a lot of the civilians do not agree with the current government stance, do not agree with the hardliner stance. So the last thing you want to do is provide a rallying cry for those entities to have a common enemy, or whether that be the West, Israel, the U.S. in general. So you're trying to do things that have ramifications without loss of life. And that's where we continue to see this push and pull. And it's something that's going to continue to play out. And the reason why we say that is because there's a lot of things happening with China in general. And before we get into the other Asian data, we just wanted to touch on this in general. So COVID has now flared up in Guangdong. Since May 21st, the following four Guangdong cities, you have Guangzhou, Shenzhen, Maoming, and Fuzhou, have all had some form of either lockdown, rapid testing. And this is something that is impacting the region. Now, they're also experiencing a big shortage or a big drought. So almost 24 cities across China's key industrial province of Guangdong are now rationing electricity to businesses as the global economic recovery and hot summer weather boosted demand as well as droughts, because they shuttered, which is actually funny when you think about the energy transition. They shuttered some coal that was replaced with hydroelectricity, and now the drought is limiting the amount of electricity they can generate. So this is creating some other issues. So are the lockdowns happening because they want to save face on some of the electricity, or are they both happening simultaneously because of other issues? Now, the Indian variant is the one that showed up, and that's one of the reasons why they're taking it more seriously than maybe some of the others, though they're responding the way they've responded in other things, because you've actually seen how contagious it is, and they're trying to get in front of that, because vaccinations have been slow in both India and China, as we talked about in segment 1, which has been a hindrance for trying to stop some of these or creating more concern when these do crop up, because then you have to get in front of it because you don't have the vaccinated to help kind of stem the tide, because as we've seen, the vaccinations are fairly good at stopping the spread. But as we've seen in Seychelles, the Chinese vaccine is not very good. But the question is it better than having nothing? And that's something that we have to look at going forward. Now, before we go into the data sets, we also want to talk about some of the shifts in general. So China adopted what was called a wolf warrior status, where they were going to be aggressive, they were going to be assertive, but they've seen that backfire in a lot of different ways. And it's hurt perception, the way the world perceives them. Now, not to say that it was good beforehand, but it has just made it much worse. And that's where we're starting to see a little bit of a pivot, and we're starting to see them soften their stance in some areas. Now, they won't shift it with the U.S., and that's going to continue to be under pressure. But we're starting to see some of that softening in other areas, and one of them was actually in Syria. So Xi actually called Assad to congratulate him on winning the re-election. So Xi reiterated China's firm support for Syria to defend its national sovereignty, independence, and territorial integrity. If that sounds familiar, it's because the West has been very adamant against Assad and the Syrian regime, as well as China, for essentially not doing any of that, where they've actually have killed innocent protesters. We've seen China stopped the Tiananmen Square memorial from happening at risk of 6 months in jail. You can go into Uiguries in that whole capacity. And then in Syria, we've seen a lot of civilians get killed using both chemical as well as conventional weaponry. So that now Xi also went a step further and said China will assist Syria at the best of its capacity in economic recovery and livelihood improvement, which is actually a big step forward for China, because they've always fallen short of helping countries on the other side. And they've gone about trying to get countries that the West has either sanctioned or have put pressure on. This is why we're talking about it, because it speaks back into Iran, because Iran is very active in Syria. And this is where we continue to see some of this pressure. And I'm not sure how happy Russia would be with this, because Russia is the one that's trying to exert more of their pressure within the region. So this, again, kind of coming to where are China and Russia friends in this whole dynamic. So, and just to kind of reiterate, helping a war-torn country with economic restriction would be uncharted territories for Beijing, and closer ties with China are an attractive prospect for countries, again, shunned by the West. So this is going to be something to watch to see if we start to see this accelerate. And it's likely we do, given that they were some of the few to show up in a lot of these African nations that are looking for money to help investments and to turn around some of the declines in production. But they also don't have the know-how that the West has, and even Russia in that sense, in terms of oil procurement. And that's where the energy transition versus investment is going to have these weird pockets of resistance, or where they will invest in oil and gas versus not. So this is going to be an interesting one to watch in general. Now, when we look at Asian PMIs, some of the things that we talked about actually as we were going through May, a lot of the leading indicators that we use were showing some pretty steady declines. Now, the declines are still keeping a lot of these countries in positive territory in terms of expansion, but well off of April pace, because not to continue to say this, but we saw that kind of big push in March and April. As that pent-up trade happened, the U.S. was pulling down more stuff. Now we're starting to see that abate, as well as COVID rising in some of these key areas, including India, Malaysia, and Vietnam. Japan has seen its fair share of struggles, as well as South Korea, which is going to keep some of this capped. And now the PMIs are now being slightly in expansionary territories, still have some of those negative factors involved that we've talked about in terms of supplier delivery times, those shortfalls, price increases in terms of input prices, which we'll talk about in a few minutes when we break it down a bit more. And these are going to be those pressure points that will remain. So even though it's going to show growth, it's actually going to have a negative impact in terms of how this moves through the supply chain, which is, again, that peak period when we look at the tip of the spear as to what is going to come into the U.S. and help essentially keep inflation elevated within the U.S. in general. But when we look at, this is just looking at India right now, when we look at the index in general, you've seen an increase in the Nifty 50 as new cases have started to come back down. They're on the other side of that peak. You still have the lockdown index remaining elevated, but it never got to the levels that it previously was. Even though the number itself is back to the highs, it wasn't a national lockdown. You didn't see the same type of decline in activity. You saw a reduction, but it never got to the same low point, and then it went sideways. Now, one of the things that we expect is the pressure to remain on the consumer, which is why consumer sentiment has gotten a little bit better, has gotten worse, because you're seeing petrol prices actually go higher. So they were already at records, and now their prices have gone up again, which again is creating some of this friction. Now the retail, recreation, flight departures, all of that will start to get better, but it's going to take time because they're going to let some of this come back down. The vaccine doses have gotten better. That will accelerate. So they're not going to want to reopen too fast ahead of the vaccines. They'll let the vaccines catch up and then reopen with them. So you'll see the lockdown last longer, or I should say the impact to the consumer last longer, but it should be better on the other side, because then there'll be more protection, more closer to some of the herd immunity that you need, and then we won't have that third or potentially fourth wave. But when we look at consumer goods inflation, it's still subdued, but the manufacturing finished goods inflation is elevated. So that's why when we look at consumer versus manufacturing, and it's interesting because manufacturing is usually depressed because you can typically export that. You're going to export some of that. You're going to see that push through, where here manufacturing finished good inflation has been pulled up, and that's going to pull consumer good inflation higher, which is why the underlying capacity, even though the numbers came in closer to what the central bank was expecting, it's still not what it needs to be, and it all indications show a big shift higher in terms of where this is going to print over the coming few months. Which is why when we just take the consumer away and look at just manufacturing. So when we look at manufacturing input cost inflation, this is where we see it's not going up again, it's just flatlining. And that's why now the flat line is going to give way to a bit more of an increase, as we do have energy prices going up again, which is a big component for India, and which is going to pull the manufacturing finished goods inflation higher again, which when you look at the month over month, this isn't year over year, this isn't showing this base effect, you're just getting this general move higher. And this next shift is going to be put more pressure within the supply chain, because they are going to export more of that. You're going to see this move back through the system, again, increasing prices throughout the world. So when we look at this in aggregate now, so the 3-month moving average of manufacturing input inflation month on month surged to 28.1% in April from 5% in February of 2020. In contrast, year-on-year inflation stood at 17.4%. So when we look at manufacturing input cost inflation, manufacturing finished goods, but wholesale price inflation, it's all pointing higher, and the input cost, or the white line, is that driving force where it's just pulling everything higher and will bleed down to the consumer and bleed into the general supply chain. So since August 2020, retailers seem to have absorbed the rising inflation in finished goods rather than passing them on to consumers. That is going to change, and has started to change based on the rate of change that we've seen in the line and where this is going to go. The 3-month moving average of consumer goods inflation eased to 4.6% in April 2021 from 7.7% in August. Over the same period, the 3-month moving average of finished goods wholesale inflation month on month rose to 9.3% from 2.4%. So you're again, all of this points to prices going up and just stressing the consumer more in India, which is going to impact general GDP activity, because the consumer just won't have the same money or the same capacity to get back to normal. And when we look at the breakdown in terms of factory gate inflation upstream to downstream, you can just see the timing delay, because obviously not everything comes down to the bottom. But it starts at, as we've been saying, the tip of the spear. You start at the top in terms of raw material inputs, in terms of processing. All of this happens, and then as you sell the inventory, which was at a lower price, and you're starting to raise those prices, even though you're going to make a little bit more margin on the front end. When you think of first in, first out, when you look at just kind of where that's going, where things that were priced, they're going out now, and the back end is going to see that inflation inflationary cycle, and you're going to see that push prices back up, which will hit not only just their export, their trade partners, i.e. the US and Europe, but also the local consumer. So then when we turn to Japan, and then when we just look at where Japan is right now, so the jobless rate got a little bit worse, but again, nothing too crazy. CPI came down a bit, but industrial production came under a little bit of pressure as retail sales slowed, as some of that kind of, again, they're trying to find their footing where things have gotten a little bit better in May. So you're still seeing a positive momentum coming out of April. And that's going to be that kind of natural consumption level where when you look at PMI on the manufacturing side, it's better than, but still not as good as it should be. And it's still expansionary, but expansionary in levels that once you back out some of the negative side in terms of delivery times, shortfalls, that's where you're going to start to see some of this pressure kind of coming down over that time period. So here's where we continue to see some of that pressure, and the profits have gotten better, but again, still going to remain under pressure in general. So then when we look at retail sales, again, it's showing just where some of that pressure is in April. Now, it has reversed a bit in May, but it's still not at pre-COVID levels, and that's where the consumption side is still struggling within Japan. And when we look at their exports and imports, you're still seeing growth, but not at the same level, especially as you start to see Asian exports kind of come under a little bit of that pressure in general. So then when we turn to South Korea, industrial production was up, which started to abate a bit in May, but should get better into June. And when we look at industrial production in April, it was expected at 0.4%, came in at negative 1.6%. And we see some of that pressure continuing through May, but then at the back end of May, we saw a little bit of a pickup, which will get this positive, but still at a fairly capped number. Now, exports were obviously at a record at 45.6, but still below expectations of 48.9, and imports came in at 37.9, below expectations of 38%. Trade balance was worse because the exports came down, and this is kind of that slowdown that we're talking about, where in the past South Korea was a very good bellwether for where China was going to be, but because we've seen a pivot out of China with supply chains moving out of China into other areas, South Korea, now while it'll show, China will still be positive, they've absorbed some of that Chinese flow. Vietnam has absorbed some of that. India, Japan, as people branch away from China, diversifying some of those impacts, which we've seen especially from Apple, just as an example. So that's why, but even with that being said, imports are starting to come down a bit. Exports are starting to come down, and this is speaking to some of the slowdown that we've seen in Asia, which we think is obviously showing in the PMIs. It's showing in ship traffic, where you're starting to see a little bit of that slowdown because demand, just in terms of pricing, you're just not seeing the same level of demand flow. So then when we look at that industrial production, this is kind of showing that drop where, and this is why we're saying it's still elevated. It's not like it's bad. It's just kind of normalizing a bit. And that's where we saw some of that continue through May, and it started to flatline. So it may come down a bit more, but again, it's still going to be strong. It's still going to show growth. We're still going to see exports and imports remain strong in general because they have become a bigger part of that supply chain, especially when you factor in the tech stocks, where we are with semis and the shortfalls. So there's still a big component of that. And this is just looking at South Korean imports and just where you can see just the general strength. But when you look at trade balance in general, you can kind of see the softness that's come into that a bit. And that's where we see some of this pressure, where some of this, and especially when we get past the year over year and just those depressed comps, you're going to start to see this come down, and imports are indicating that exports are going to continue to fall in general. So then when we look at just India, and the reason why we're now jumping back to India is because you have to look at where that supply chain has moved to outside of China, and that's when you look to India as well, which is essentially still expansionary, coming in at 50.8, but again, so close that the margin of error, they're actually in a flatlining state, and even, if anything, slightly contractionary, because a lot of the inputs that had gotten them to the positive level are, again, that net negatives that we've talked about in the US and Europe in general. So now when we look at China, non-manufacturing PMI came in slightly above expectations at 55.2, manufacturing slightly below at 51 instead of 51.1, bringing the composite to 54.2. But the cash-in China PMI manufacturing came in at expectations of 52. So you're still seeing growth, you're still seeing expansion, but there's pressure on that expansion. And that's where we look to the consumer in general. So a recent surge in prices for raw materials such as iron ore, crude, coal sent the sub-index for input prices to 72.8 in May, the highest level since November 2010, while output prices notched up a record high reading of 60.6, according to the numbers. So that's why you're getting a little bit of flatlining now at that sub-index of input prices, but the 72.8 versus 60.6 just shows that there's still some of that capacity to pass on some of that cost, which is why China is struggling, because there's only so much cost they can push down before people or their clients essentially, or I should say customers, say, look, I'm going to have to go elsewhere. I'm going to buy from other regions. So, but not everyone gains in the higher input cost, because total new orders retreated to the lowest level in a year as fewer bookings from overseas markets push new export orders into contraction territory. So again, that's going to be that negative movement, which is why we think pressure is going to mount as we come in, as we go through not only just May, but into June. Now, Chinese exporters were also under pressure from the yuan's rally, which is why they've started to really go after and try to weaken some of this recent rally, which has put a fairly, I don't want to say it's put a bid in the dollar, because it hasn't. It's just stopped it from going down, because they're trying to cap some of this rally and, again, trying to make their exports more affordable. So financial regulators said in a meeting last week that the yuan won't be used as a tool to support exports, which is a lie, via depreciation, because they've already started to do things to try to depreciate the yuan. Monday's data showed larger manufacturers performing better, while a sub-index tracking small enterprises fell into contraction. And this is the bifurcation that we see in the market in general, where we're getting this pressure pushed down on, where it's large entities have gotten better, but now we're starting to see this pressure as that smaller sub-index, and which is why the Chinese government is trying to support the smaller entities, because they continue to struggle more than the SOEs and the larger enterprises. And this is just looking at, on a chart level, kind of where we sit. And it's because it's Chinese numbers, you can see that things have flatlined a bit. But when you read between the lines and look at the different tea leaves, we look at supply chain, we look at manufacturing, and just where the boats are going in general, we continue to see headwinds within the Chinese data sets. But when you think about these Chinese data sets and how they're trying to build out more local consumption and trying to drum up support in international markets, Xi offered they held their World Symposium for Marxist political parties. Marxism obviously is a deep underpin to China. And the event itself, so it hosted 70 representatives from 58 political parties across 48 countries. The event was sponsored obviously by the International Department of the Party Central Committee. And Xi said, a strong ideological weapon for us to understand and reform the world. The CPC has made Marxism a guiding principle and insisted on aligning the basic principles of Marxism with the actual conditions of the country. Marxism has developed with fresh vigor and vitality in China in the 21st century. Now, think back to how they want to soften up wolf warrior, but when you have this kind of ideology, it's very difficult to adjust the narrative and how it's being presented to others. So when you think about how this is going through, the view is that there will be no class struggle and no exporting of revolution, but there will be an intense focus on economic development. So that's why they're trying to pivot look, we don't need to export and influence through revolution, but we're going to use our economic might, and we need to do it because we don't have the local consumer. We're at odds with the U.S., so we need consumption, and that's where how are they going to support PMIs? How are they going to move this product with this kind of pressure going through in general? So when you look at the Young Pioneers, is on the other side, looking at the young level, the Young Pioneers is a political organization for children aged 6 to 14, which operates under the Communist Youth League of China. And Xi said, apply what they have learned from the party's history to their own lives, follow the example of heroic role models, study hard, and foster faith and integrity. China's political environment continues to tighten emphasis on a correct understanding of history, in being the key, is being emphasized at all levels. Xi and company believe the best way to ensure broad ideological orthodoxy is to start kids young. Again, trying to drum up that propaganda, bring that into the hearts and minds of the young. And wolf warriors are not the real problem here. China's global propaganda efforts were failing long before they arrived on the scene. As long as spokespeople and state media are constrained by highly ideological formulations, China's message will continue to fall on deaf ears. So again, this is where the conflict continues to arise, leading to this additional pressure as people look to diversify away from China and some of this ideological push and this pressure to reform economic policies. Again, movement of supply chains is real and changing. And this is just looking at some of the pressure that remains where China manufacturing output prices have taken out that 2016 high, that 2018 high, and there's only so much they can pass down because they're already getting people moving their production, moving supply chains, and this is just another problem that they face. Where now, with that being said, there's been a sharp decline in the local government financing vehicles because they've sold the least amount of domestic bonds last month since 2017 as new stock exchange approval rules tighten deal activity. This is what we were talking about. We're trying to put pressure, but yet they've kept the SPB, the special purpose bonds, fairly flat because provinces and local governments need some form of monetary support, which the PBOC and the CCP are trying to drum up from the bottom. So just 1/3 of years following a record 2 trillion yuan of sales during the first 4 months of 2021, again, well above where they wanted them to be. So now you're getting that catch up. Investor appetite also weakened due to record bond defaults in China, meaning last month's sluggishness may continue. And that's the conundrum because SOEs were supposed to be safe. Now, with Yurong, they've been proven not to be safe. So how do you essentially fix this? And the idea is take some of the capacity out of the market. But how do you do that? You have to move some of this capacity around, coming to the Yangtze River Delta Integration leading a small group. So when you look at the YRD, or the Yangtze River Delta region, as we talked about in 2 of our shows looking at the Three Gorges Dam, they want to take this urban amalgamation centered on Shanghai and including the neighbors. So they want to create this greater Bay Area, an economic circle, and this economic belt. But the water situation and the flooding is becoming a big problem, and they're trying to come up with ways to drum this up, but they need money to do it. So they're trying to get it from the top versus those local bonds, those local levels, to try to take some of the risk out because they need to flush the system, but it's easier to hide it a bit at the PBOC side, CCP level. So the push for regional integration is about improving economic efficiency and environmental protection by tackling fragmentation. Again, trying to come from the top down. Inter-regional competition has produced wasteful industrial duplication on massive scales. Again, not trusting the locals. So flush local bonds, local debt, and then have people on top kind of managing this from the top down to avoid this waste, which is, again, trying to move the needle on where a lot of this debt resides. So then taking this to the next level, well, this is why. When you look at Yurong needs to refinance or repay 6.2 billion of notes this year, and a huge chunk of it is happening in November and again in June. So offshore bonds big slug is due in June and a big amount is due in November. And they have to find ways to build confidence to bring a lot of these interest rates down because they've been trading at a fairly big discount. And how do you do that? Well, by acknowledging that there's a lack of supervision of the most senior officials is still a big problem. We must soberly recognize that supervision of the number one boss is still a weak link. Top-down supervision is most effective for number one bosses. The Central Commission of Discipline and Inspection and Central Organization Department will step up supervision of provisional party committees and number one bosses of central departments. Again, the Yurong CEO was killed for what he had done. He was executed for it. So when you think about the failures, and the CCP keeps trying to say, look, you have been acting outside of party interests, and that's your fault. It's not because of our policies, it's because of you, the people we trusted to carry it out. You're going to be the scapegoat, and we're going to have to come in and fix it. Never allow members of the leadership team to turn their portfolios into private territory. Again, that private communism, Marxism, private territory, which is free from collective leadership and supervision. These, again, are the friction points, and they're using the Yurong situation, the massive amount of duplication, these huge debt loads at the provincial, local government level to say it's due to failure of abilities. But the propensity to consume, it still comes down to the consumer. So nationwide, they're still not at pre-COVID levels. They're still well below pre-pandemic levels. The rural they've all bounced back, but China has been open for a long period of time and have yet to normalize, even though the Chinese government has done everything it can to try to incentivize spending. Again, putting more pressure on the underlying economy. So then when we look at just some of the other issues, as we said earlier, the lights out in Guangdong, where at one point Guangdong ran a power supply gap of 6 to 8% due to obviously the demand for air conditioning, economic recovery, price of thermal coal is being used. So the price of thermal coal is at a 3-year high. And droughts in the Yunnan have reduced hydropower. So they have a reduction in hydropower, massive surge in coal pricing, creating a problem for just electrical demand. So again, these are issues that continue to crop up when we're looking at the lost capacity and how things are shifting, because China is still struggling to get back to normal. Again, speaking to just the hurdles that the world still faces when we're considering how do we get back to normal post-COVID. And that's when we look at, again, weak retail. Pre-pandemic 5-year average was that 0.7%. And when we look at month over month, this is now the second month that we've seen track below pre-COVID levels or the 5-year average. Year over year, obviously there's that nice little surge after we had those big dips. But when we normalize it on a month-over-month level, the trend is moving in the wrong direction as the consumer continues to stay home and just not consume the same levels. And it's happening at all income levels. And I think this is one of the bigger issues when we consider how can they change this. They've talked about trying to incentivize, take from that highest level and put it lower. And you can see that it's just happening at all levels of consumption, because people just don't feel confident. That it comes down to savings. It comes down to these pressure points that remain throughout the underlying, Chinese economy. And if you think about China being the second largest economy and the growth engine for a lot of commodities, a lot of, oil consumption, these are some of those problems that reside within the system that I think is going to be that headwind when we consider kind of what comes next coming from Chinese consumption, Chinese growth. That is why we talk about credit impulses and what comes next in the commodity cycle, because these are headwinds that are real and are persistent, even though China's been out of COVID for over a year now. So again, these are things that we like to look at and consider. So if you have any questions, please let us know. We love the back and forth. Thanks again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Prime Vision Network.